S&P 500 hits all-time high today, while a war is happening. April 16, 2026. April 16th, 2026 is the date that Wall Street will remember. Today, right now. As missiles have been fired, oil has surged, and the USA is technically at war with Iran. The S&P 500 just hit an all-time high. SPY, the most traded ETF on the planet, is trading at $702 per share. The S&P 500 index itself touched 7037 today, a number the market has never seen before in its entire history. And the question everyone should be asking is, how? Why? And most importantly, what does this mean for your money? Stay with me, because what's happening right now in the markets is one of the most fascinating and potentially dangerous moments in modern financial history. Let's break it all down. First, let's talk about the actual numbers because they are stunning. The S&P 500 reached its all-time high of 7037 today, April 16th, 2026, light finance. SPY, the SPDR S&P 500 ETF, hit a new record high of 70203 today, opening at 70116 with a 52-week range stretching from 508 all the way up to today's record investing.com. Let that sink in. From 508 to 702 in just 12 months. That's a 33% gain in 1 year. Yesterday, April 15th, the S&P 500 closed above the 7,000 level for the first time in history, finishing at 7,041. The Nasdaq posted its 12th consecutive positive session, its longest winning streak since 2009, and the Dow added over 115 points, closing at 48,578 CNBC. This week alone, the S&P 500 is up 3.3%, and the Nasdaq has surged 5.2%. CNBC. These are not normal numbers, people. These are historic. Now here's where it gets wild. This is all happening while the United States is at war with Iran. Markets are soaring even as 58 billion in energy assets lie in ruins. But booming indexes don't erase the impact of the war, with the World Bank warning that conflict-related disruptions could last for months. The Iran war is showing up in the US economy in ways both obvious and not so much, with soaring energy costs leading the impact and potential hits on broader growth simmering beneath the surface. The Strait of Hormuz, a critical choke point for roughly 1/5 of the global oil supply, has been severely disrupted since late February following Iranian actions and a subsequent US naval blockade. And yet, stocks are at all-time highs! So what is Wall Street seeing that the average person is not seeing? Here's the answer, and it comes down to 4 key forces. Force number 1. The Iran war ceasefire optimism, helping fuel the rally. President Trump said the war with Iran is very close to over. Israel and Lebanon are also holding talks today, and Israel halting its attack on Lebanon has been a key condition for the Iran negotiations 24/7 Wall Street. Markets are forward-looking. They don't price in today, they price in tomorrow, and tomorrow, traders are betting this war ends. Force number 2. Corporate earnings are crushing it. Earnings expectations for Q1 have been revised higher, with S&P 500 companies now forecast to report combined profits of over $6 to $5 billion. Up from earlier estimates, bank executives highlighted a strong US consumer and a healthy pipeline for deals and IPOs. Force number 3. The AI boom is unstoppable. Tech shares, particularly those linked to AI, provided additional support. The Nasdaq's outsized gain reflected renewed enthusiasm for growth-oriented stocks, even as broader economic projections softened. TSMC, the world's largest chip maker, just reported a 58% jump in first quarter profits, beating estimates and hitting new records thanks to unstoppable AI demand 24/7 Wall Street. Force number 4. Retail investors are FOMOing in. Retail traders who had largely sat out the latest equity rally are beginning to chase the upside. JP Morgan data show retail buying activity rebounding sharply, with overall participation rising to the 55th percentile from roughly the 10th percentile just days earlier. When retail starts chasing, markets tend to keep going, at least for a while. But before you go all in on SPY right now, let me be the voice of reason. Because not everyone on Wall Street is celebrating. Morgan Stanley warns that geopolitical risk is becoming a persistent part of the market backdrop, not just a temporary shock. And that investors may need to price in a world where regional conflict and strategic competition continuously drive markets and risk premiums. Even if the ceasefire holds and military activity winds down, the restart of energy production will take time. Damage to LNG facilities, refining capacity, and energy infrastructure may take months or longer to come back online. If fighting resumes, the future becomes much murkier. Oil prices will be key. And $125 per barrel for WTI crude is the point where it becomes more of an economic problem, according to RSM chief economist Joseph Bruce Wellers. And there's one more thing I want you to hear. Some analysts warn that the market may be slowly showing signs of overextension with evidence of euphoria, particularly in the AI application layer, more distinctly present in private market funding than in public markets. In other words, be careful out there. So we ran today's market data through our AI models. And here's what the analysis suggests. Not bullish scenario. The ceasefire holds, oil stabilizes, and earnings continue to beat SPY. Could push towards 740 by summer. Light neutral scenario. Conflict drags on but doesn't escalate further. Markets trade sideways between 6 CD80, 7-ton volatility remains elevated. Time bearish scenario. War escalates. Strait of Hormuz stays blocked. Oil spikes past 125. The IMF has already cut the 2026 global growth forecast to 3.1%, with headline inflation seen at 4.4%. For the year under a short-lived conflict scenario, risks worsen significantly if tensions escalate. Euronews SPY could pull back to 16.274016. Which scenario do you think is most likely? Drop it in the comments pile. Here's the bottom line for today. April 16th, 2026. Wall Street is telling you one thing, the war headlines are telling you another, and AI is giving you the full picture. History shows that in past US-involved wars, equity markets frequently experienced short-term volatility followed by recovery and gains. The S&P 500 rose over 25% in the first full year after the 2003 Iraq War began, Euronews. But past performance is never a guarantee. Stay informed, stay diversified, and never invest more than you can afford to lose. If this video gave you value, smash that like button, subscribe, and hit the bell so you never miss our daily AI-powered market breakdowns. I'll see you in the next one. So we ran today's market data through our AI models. And here's what the analysis suggests. Not bullish scenario. The ceasefire holds, oil stabilizes, and earnings continue to beat SPY. Could push towards 740 by summer. Light neutral scenario. Conflict drags on but doesn't escalate further. Markets trade sideways between 6 CD80, 7-ton volatility remains elevated. Time bearish scenario. War escalates. Strait of Hormuz stays blocked. Oil spikes past 125. The IMF has already cut the 2026 global growth forecast to 3.1%, with headline inflation seen at 4.4%. For the year under a short-lived conflict scenario, risks worsen significantly if tensions escalate. Euronews SPY could pull back to 16.274016. Which scenario do you think is most likely? Drop it in the comments pile.